Good morning, good afternoon, good evening. It's your boy Gary Scott, aka the Solid Pip Assassin. Today, guys, we're back with another educational video. On this video, guys, I'll be going over some written examples and then I'll be showing you guys some live examples of how I put together the power of three method. All right, power, all right, of three method. All right, power of three method. All right, this is what I call my method. This is how I found a way to simplify the market, I believe, for anybody that's looking to get into trading. All right. And the reason I call it the power of three is because there's three key things for everything that's in the market. All right. One thing that I will not go over is the candlesticks because I will want you to study those yourselves. All right. I will give you guys examples of when it'll be ideal for you to find these particular candlestick setups in this example today. Okay, guys, in this lesson. So, with that being said, let's get straight to it. All right. First things first. All right. You have three types of trends. All right. You have an uptrend, you have a sideways moving market that we also even like to call consolidation. All right. And then you also have a downtrend. All right. In an uptrend, the only thing you want to be doing in an uptrend is finding areas to buy from. All right. You do not want to sell in an uptrend. All right. You do not want to sell in an uptrend. I'm going to say it again. You do not want to sell in the market that is moving in an uptrend. All right. Now, you have a consolidation ranging market or sideways moving market. This is something that I would also suggest that you do not trade in. All right, especially if you're not an advanced trader. The only thing that's beneficial when it comes to a sideways moving market or a consolidation ranging market is to catch the move after it's done been in consolidation. All right. More times than not all the time, but a great majority of the time, whatever happens before consolidation will tend to happen after. All right. Um, so just take heed to that. Make sure you have that down. Now, a downtrending market. If the market is moving in a downtrend, the only thing we want to be doing in a downtrending market is selling. All right. In a downtrending market, you should not be buying. All right. In a downtrending market, you should not be trying to find areas to buy from. Okay. Because you'll get caught um, with trades going against you. Okay. Um, Outside of that, guys, right? You have your areas of value. All right. You have your three key areas of value, which are your order blocks, your fair value gaps, and your structural levels. All right. Again, your order blocks, your fair value gaps, and your structural zones. All right. Now, these are the areas, whether you're in an uptrend or a downtrend, that you actually want to take these trades from. These are the only areas you need to be taking your trades from. Now, if you're in an uptrend, right, price is always going to find an area of value to retest to so that way you can actually take a trade from that particular level. Okay. So give me 1 second. I'm going to draw it out here. When price is making consistent higher highs, higher lows, higher highs, higher lows, higher highs, higher lows, right? And then it's eventually going to make a new high. Now, when price breaks a level of structure in an uptrend, that gives you your break of structure, all right? BOS. Now, when price surpasses this level, okay, when price surpasses this previous high and makes a new high, it's going to find one of these three levels to actually retest to, so that way you can actually take your trade from that particular level. All right. So for example, right, price broke above this particular last high that was here. When it creates this new high, it's looking to retest. Now, this level that it actually retests to was a previous level that actually was broken, right? A previous level of structure that was actually broken. So, for example, it'll look something like this, right? It'll have a structural level. all right, that price came back to, right? And once price reaches this level, you may get rejections, you may get candlesticks that actually close above this particular level. Now, if you get a bullish candlestick pattern, right? Bullish candlestick pattern. If you get a bullish candlestick pattern, this is where you want to see a candlestick closing above this structural level. If you get a bullish candlestick closing above this structural level, right, you would naturally take your entry here, all right, and you will want to have your SLs beneath this structural level, all right, or beneath this area of value. That way, if a trade happens to close beneath this structural level, then there's a great chance that price is going to continue to fall down to the downside. All right. Now, you always, as a trader, at least want to go for a 1-to-1 or a 1-to-2 risk to reward ratio. All right. What is a 1-to-2 risk to reward ratio, Gary? Well, if you see here, especially if you're on trading view, right, it's always going to have either a number one right here, and that gives you your 1-to-1, or you can have a 1-to-2 risk to reward ratio. What does that mean? So if my SL is 35 pips, right? If my SL was 35 pips, that means that at least my TP1 needs to be 35 pips as well. And as you see, it gives you the one here. All right. That gives you your 1-to-1 risk to reward ratio, meaning that you get a 50-50 shot of either winning or losing this trade. All right. Now, once you go and you get a 1-to-2, right? What's 35 plus 35? Right? 35 plus 35 is what? 70 pips, right? And naturally what that does is aim for the next high that is looking to actually be taken out. All right? Once that happens, you then get another what? Break of structure. All right? You get another break of structure. Now, what happens is price creates that new high, right? You make your money off of that 1-to-2 risk to reward ratio. Now, when price decides to retest, right? Like I said, there are three levels that price can come back to. In this case, right, price came back to not only a structural level when it stopped here, right, but it also possibly fell down below that particular point to then find another area of value. Let's say, for example, right, you get this area of value right here, which is a structural level. Price makes a particular pattern that I haven't went over yet, right? But we like to call this a double bottom. All right, this is a double bottom pattern at a structural level. What ends up happening is price creates this double bottom, but then it manipulates, possibly coming to touch one of these two areas of value, whether that's an order block or a fair value gap. Now, let's just say for all intents purposes, this happens to be an order block. All right. Let's say that that's an order block, right? Price came back to one of the last down candles before price actually broke structure. All right. So when price comes here, right, all we need to see from this particular level, right, is a bullish candle closing above this order block, which then gives you the opportunity to take this trade from here with the bullish candle closing above that area of value, right? SLs will then be beneath for again a 35 pip SL. And then you're naturally wanting to aim for a what? 1-to-1 or 1-to-2 risk to reward ratio. So whatever your SL is, right? You need to make sure that your take profit is at that same margin, right? Moving in a upwards direction. All right. That gives you your 1-to-1 risk to reward ratio, 35 pips. Now, if you want to go for the 1-to-2, again, that's 70 pips. If you want to go for a 1-to-3, right? A 1-to-3 is what? Let's see here, right? Over 100 pips, right? 105 pips naturally. Okay. And what that does is it always gives you an opportunity to what? Minimize your losses to maximize your gain in the market. Okay. Now, let's say, for example, this price created this bullish candlestick market pattern. All right. As we see here, we have our bullish market patterns. You have a double bottom, a triple bottom, and then you have a inverted head and shoulders. So again, a double bottom, a triple bottom, and then a inverted head and shoulders. These patterns either start an uptrend or they will be continuation patterns for, within an uptrend. Okay. So for example, price created this double bottom here. Sometimes price will create these double bottoms to then push up to manipulate price back to the downside for it then to actually go. And in some cases, right? In some cases, price can actually create this double bottom at this structural level, right? And all you would need to see is what? Bullish candlestick confirmation patterns, right? Bullish candlestick confirmation patterns above that level, right? For you to actually aim towards the previous high, right? And naturally, it's already going to give you a what? A 1 to 2 risk to reward ratio. Okay. All right. So you have those examples there. But then again, what happens? You then get your break of structure. From that point on, right? We got our break of structure. Let's just say, for example, right? One more example, price came from this level and reached, right? Possibly either a fair value gap or an order block level. Let's just say, for right, all intents purposes, price came back to a fair value gap level. All right. What a fair value gap level is, it consists of three candles, right? You have three candles, but that middle candle and those two outside candles, right? The two outside candles have wicks on those candles, right? And I'll give a better example when I show you guys in real time what that looks like. But it has a candle with the wick, and then you have the next candle, and then there's another candle right after that one that has a wick also. But those wicks on those two outside candles don't meet in between the body of the middle candle, right? And as long as there's a space in between the body of that middle candle, that is considered a fair value gap level. Now, I will explain what that looks like later on, all right? But price comes back to this particular level, right? What ends up happening? We want to see bullish candlesticks coming and closing above this fair value gap level. So that way, right, you catch your entry, right? SLs will go beneath that area of value, naturally giving you a great risk to reward ratio, right? You have a 45 pip SL, meaning that you at least have to have a 45 pip gain. All right. Everybody sees that, right? Now, if you want to say, let's say you want to go for a 1 to 2, what's 45 plus 45, right? 90 pips. Naturally, what will end up happening, if price is still following suit of the uptrend, it will look to go actually take out those highs. All right. For everybody that's on the call with me right now, if everything is making sense thus far as the uptrend goes, right? Type a 3 in the chat. All right, good. Now, that's the example for an uptrend. Now, this pattern right here, these are key market shapes in the market, right? You have a descending triangle, right? You have a symmetrical triangle, and then you have a ascending triangle. Now, the descending triangle would tend to start a uptrending market, okay? So it'll be an example like this. Price comes, right? It's making consistent higher lows. Price then starts to create a descending triangle that then has price to shoot out, right? Then retest and then possibly take off again. Okay, that's your descending triangle. For your symmetrical triangle, price can come from any direction. It can come from a downwards trend, right? looking to head to the downside, or it can come from a upwards trend, right? Looking to go to the upside. Okay. So price can go either way for a symmetrical triangle. Now, for a ascending triangle, right? Price will be moving where? In a downtrend, right? Boom, 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 for price to continue to go lower. All right. So you have those examples there. Okay. So when you see price creating these particular triangles in the market, you have to be on your toes. Now, what will happen is price, like I said, will be moving in a downtrend. It'll find a level of resistance in the market so that way price can head lower. Okay. And then for the descending triangle, price will be moving in an uptrend, finding a level of support so that way price can actually push higher. Okay. Again, I'm not going to explain the sideways moving market or accumulation or consolidation trend because you want to stay clear of this. Now, just as I went over the uptrending and you only want to find bullish candlestick patterns from these areas of value, right? You want to find these, right? Let's just say this happens to be just to kind of spread it out, right? Let's just say this is an order block level, right? For example, remember, it's the last down candle before price actually breaks this level of structure, right? Let's say that that's an order block. You want to see bullish candlesticks coming from these areas of value. Now, going into the downtrend side of things, right? You have bearish market patterns. You have a double top, a triple top, and then you also have a head and shoulders pattern. All right. Now, these again, they will start a downtrend or they will be continuations within a downtrend. All right. So when price decides to break, right, a low in the market, right, because now we're in a downtrend, it creates lower highs and lower lows, right? Lower highs and lower lows, right? Lower highs, lower lows, lower highs, lower lows, right? To then create a new possible low. All right. In this case, when price breaks this level of structure and creates this new low, it gives you your what? Your break of structure. All right. Now, when price decides to retest, again, it's looking to come back to one of these three areas of value, whether that's a structural level, a fair value gap level, or an order block level. Now, in a downtrend, what a order block level looks like in a downtrend is the last up candle before price breaks structure. Okay. It's looking for the last up candle before price had broke structure. So in this case, right, it'll be here. We say that that's an order block there. All we need to see is bearish candles closing beneath this area of value. What will then happen is you see that bearish candle closing below, right? We need to have our SLs above, right? Let's say we have them let's say we have them at least at 50 pips, right? A 50 pip SL means you need to at least have a 50 pip gain. All right. That gives you your what? Your 1-to-1 risk to reward ratio. Now, let's say you want to aim for the lows, which is perfectly fine, right? You want to have at least a what? 1-to-2 risk to reward ratio in this case, right? That'll give you, right? What's 50 plus 50 or 500 plus 500, right? That's 1,000 pips or 100 pips depending on what pair you're trading, right? This method works with every pair, with every time frame, right? You just simply have to follow the trend, okay? You have to follow the trend so that way you're able to capitalize off of this method, okay? Now, you have that. SLs will go above your area of value now instead of below because now you're in a downtrend, okay? When price decides to break structure, right? You get your break of structure here. And then now you're looking for price to create that new low for then price to retest. Now, in this case, when price decided to retest, it came right back to where? A structural level. All right. And at this structural level, what ends up happening? Price creates a triple top. All right. And at this level of structure, you get your triple top. So now you're looking for price to be in a continuation move towards the downside. All right. Everybody got that. That makes sense, right? If that made sense for you, everything that I just kind of went over for you guys, that's making sense. What I want you to do is to type a three. All right. Type a three. All right. We got people on the call. So make sure if it's making sense to you, type a three in the chat. I need everybody to participate. Okay. Everybody's good. All right. Now, we went over these examples. All right. We went over these examples. Now, let's go in real time now and let's actually find these trends, find these patterns, find these shapes, find these areas of values and these particular candlesticks in real time, right? And the reason that I call this method the power of three, like I said, is because you have three trends, right? You have three areas of value, you have three bullish market patterns, right? You have three bearish market patterns, and then you have three key market shapes. All right. Not only that, but you also have three types of candlesticks. You have bullish candlesticks, you have indecision candlesticks, and then you have bearish candlesticks. All right. Now, let's go in real time and let's actually find a down let's find an uptrending market first, right? Let's go and let's find a uptrending market. All right, we're going to go back in time here. And here we are, right? Can anybody that's on the call, right? If we just take a step back and look at this market, what type of trend do you believe this market is actually in? Okay. What type of trend do you believe this market is actually in? All right. We have somebody that says up, right? Shay says up, right? Everybody's saying up. Okay, great. Now, in this trend, what do you feel like you should only be doing? Right? What is the thing that we should only be doing in a uptrending market? Longs, meaning buying, right? We want to buy. We want to find areas to buy from, right? Now, for everybody that is on the call, if we're only buying in an uptrend, what are the three areas of value that we should be anticipating price to come back to so that way we can take the trades from discounted areas? All right. What are those three levels? What are those three levels? What are those three levels? Type them out. Structure, fair value gap, and order blocks. There we go. Structure, fair value gaps, and order blocks. Now, for anybody that was like, okay, what does a fair value gap look like in real time? Well, let me show you. All right. Before we get into the examples of how to attack an uptrend, let me show you guys what a fair value gap looks like. So, all right, we remember it consists of three candles, how you're able to find a fair value gap. If you notice in this particular candlestick here, there's no wick. And then there's a candlestick here, and then there's another candlestick here. If you guys notice that there's no wicks on either side of these two outside candles, meaning that that is a fair value gap level. So from body to body, right? This gives you a fair value gap level. Okay. And let's mark it off as such. Now, what I want you guys to understand, sometimes there will be wicks sticking out the bodies of these candlesticks, right? And let me make this our line. So sometimes you'll get levels like these where this candlestick wick will stick up and then there's possibly no wick here, right? Then that will make this still a fair value gap level. Okay. Then let's say, for example, there's a candlestick wick coming from this particular candlestick, but there's still some type of space in between the body of this candle that still allows you to have a what? A fair value gap level. All right. Everybody got that, right? Let's just say, for example, now that these two wicks actually meet in between the body of this candle, right? Prime example right here, right? Is there any space within the body of this candle? Absolutely not. So that allows you to know that that's not a fair value gap level. Okay. Now, I explained what a fair value gap looks like for an uptrend, right? Now, we're looking at the market. Now, out of all the market structure patterns that I showed you, not shapes, but patterns, out of all of those three that I showed you for the uptrend, what does this one look like? All right. What does this one look like? What type of pattern does this look like? Anybody? Let's go. Anybody that's on the session and on the call right now, what type of pattern is that? We got one answer. We got two. We need a couple more. Couple more. Let's go. Let's go. What type of pattern does that show you? Right? And this is the reason why price started to move in an upwards trend. All right. If you said inverted head and shoulders, you are correct. All right. Inverted head and shoulders. If you said inverted head and shoulders, you are correct. Okay. Shoulder, head, shoulder. Okay. Now, how are you able to know that the market is now going to start moving in this uptrend? Okay. What's going to happen is price is going to find a way to break a previous, right, high, right? It broke this high, then it ends up breaking this high. So what ends up happening, right? Price ends up taking out highs to give you your what? Your break of structure. Price creates this new high, price falls down, right? When price decided to break this structure, the question you have to ask yourself is where price actually came to, right? Over here, it came back to a what? A fair value gap level. From here to here, right? You get your fair value gap level, right? You see that? From this candle to this candle, there's no wicks impeding within the body of this one, all right? Which gives you your fair value gap level. All right, it breaks structure. It comes right back to a fair value gap level to then from that point actually breaking structure. All right, whether it's by wicks or by bodies, as long as price surpasses a previous high, that gives you your what? Your break of structure. All right, what then happens from that point on? Right, let's just delete this fair value gap level. Is you actually get a break of structure, price decides to retest. The question you have to ask yourself is where can price retest to? After it breaks structure, it's looking to find one of the three levels, whether that's an order block, a fair value gap, or a structural level. Now, based off everything that I've taught you guys up until this point, right? What level do you feel like price actually stopped at? All right. I'm gonna give you guys a few seconds. right? I'm gonna give you guys a few seconds. What level did price actually stop at right here? When it stopped here and it rejected and pushed up, where did price actually stop? All right. It stopped at one level. What is that level that it actually stopped at? If you say a fair value gap, you are correct. Okay. You are correct. And here's the fair value gap level here. All right. So from here to here, if we pull that zone all the way across, you see how price reacted off of that level. Now, remember when I told you when price breaks structure, right, and it retests, it's looking to come back to one of the three levels. In this case, it came back to this fair value gap level. But remember, also, once price gets to these levels, to actually find your confirmation and know that you can actually take the trade higher, you need to find a bullish candlestick closing above this particular area of value. All right. Now, if I catch my entry, all I need to see is a bullish candlestick closing above my area of value. I take my entry after that candle closes. Okay. And then I have what? My SLs right beneath this area of value. It gives me a 50 pip SL, meaning that I need to at least go for a 50 pip gain. That naturally gives me my what? My 1-to-1 risk to reward ratio. All right. And if you see here, price went into drawdown just a bit before it actually went to go take out your take profit. Now, let's say, for example, you actually want to go back above these highs. What you need to do then is, right, at least aim for a 1-to-2. What's 50 plus 50? 100. So if it gives you, right, if your SL is 50, that means if you want to go for a 1-to-2, your take profit needs to be at least 100 pips. All right. And as you see, you get your 1-to-2 risk to reward ratio, right? What ends up happening to price? It goes out and takes out your take profit. You make your money, you go about your day. Okay. Now, what ends up happening at this moment? Price decides to do what? Breaks this level of structure, right? Gives you your BOS. Price then creates a new high, right? It creates this new high for then price to do what? Retest. All right. Remember, it's going to try to find one of the three levels. Naturally, what you would want to see is price to pull back beneath the break of structure zone. So that way you can find an area of value deeper. But sometimes when price does break structure, all right. When price does break structure, it may create a new high and not even come back near this level. But there will always be some type of area of value that price would actually come back to so that it can actually respect it and react off of it. In this case, can anybody tell me what price came back to? All right. Can anybody tell me what price came back to before I draw it out? All right. Let's see. Let's see what somebody says here. All right. There we go. Fair value gap level. All right. What does that fair value gap level look like? It's right here. All right. From this candle all the way down to this candle, you have your fair value gap level. And if you notice what happens to price, it comes and taps this fair value gap level. And then it gives you a bullish candle actually closing above. So what you could do, right? In many cases, in most cases, right? Well, I'm not going to say in most cases. Sometimes what may happen is even if you have, let's just say, a 40 pip SL. There may be times where price may even run past your area of value to come find a deeper one, right? And this may be sometimes you may lose a trade like this, right? You may not win it, but sometimes you, like I said, you may lose this trade because it may even come back deeper to find another area of value, either at this structural level or at an area of value beneath those breaks of structures. Okay. But in this case, what ends up happening, you get a bullish candle closing above what you would like to see, right? And then naturally what you want to do is you naturally want to go for your 1-to-1 risk to reward ratio, right? If my SL is 40 pips, then my take profit needs to at least be 40 pips. Now, if I want to go for a 1-to-2, what's 40 plus 40? 80, right? That gives you your 1-to-2 risk to reward ratio. You make your money, you go about your day, right? What ends up happening? You get a break of structure, right? BOS, for price to create these what? New highs, right? For then price to do what? Retest. But the question you have to ask yourself is, what is the level that price is looking to come back to so that way it can react to push higher, right? If you guys notice here, this is a structural level, but there's also another area of value that lies within that area of value. All right. Yes, you get your structural level, right? But then you also get what? Another area of value sitting right on top of that area. All right. In most cases, right? What do you have? This is one of the last down candles before price cleanly broke structure. All right. Right here. So from this candle's bottom wick to that candle's top wick, that gives you your what? Your order block level, right? Remember, I told you it's the last one of the last down candles before price cleanly breaks structure. All right. Price comes right back to this level, gives a strong rejection and a strong bullish candlestick, actually closing above both this structural point and this order block level. Okay. So naturally, what you would want to do again is buy here after this candle closes, right? SLs will go beneath this zone, right? Whether it's the structural level or this wick, right? You can put it beneath this candle's wick, which will be an ideal level for the most part. But in some cases, again, you can put your SL beneath so that way you can have some room for your trade to actually breathe. So that way you can actually aim for your initial target. Okay. So let's say, for example, just say, for example, we have a 60 pip SL, right? That means you at least want to go for a 60 pip gain, giving you your 1-to-1 risk to reward ratio. You make your money, you go about your day, right? If this has made sense up until this point, what I need everybody that's on this call to do is to type a 3. All right. Type a 3. Now, anybody that's on, they're going to be watching this recording. Again, you might just want to rewind it again so that way you're able to, follow along so that way, everything is making sense for you. All right. But this is an example of how you can properly attack an uptrending market. All right. This is how you properly attack an uptrending market. Now, everybody got these examples down, right? We got these examples down for an uptrend. Now, what I'm going to do now, before I go into actually going into the downtrend, can anybody tell me the type of pattern that was actually created near this level? All right. What particular pattern do we have here? All right. What particular pattern do we have here? Does it look ideal to the image that I gave you at the very beginning? No. But what type of pattern do we have? Right? If you said double bottom, you are correct. All right. You have a double bottom near a structural level and also an order block level. So that gives you a double bottom near in at an order block zone. All right. Everybody see that, right? Double bottom. Price creates the first leg to then create the second leg for price to actually shoot higher. And remember how I told you, it creates these patterns so that way it can be continuations, right? So an uptrend can continue. Okay. Right. So now what we're going to do is we're going to go over the downtrend, right? It's going to be extremely similar. It's just going to be flip-flopped now. All right. Everybody should have heard before in their life, whatever happens on one side happens on another. All right. And that's most definitely true. All right. And everybody should know what operate and what the world operates off of. Right. The world operates off of supply and demand. What is supply and demand? Supply and demand is another word for order blocks, right? Order blocks is another word for supply and demand. Okay. In a demand moving market, the market should be moving up. In a supply moving market, the market should be moving down. So, right, if an order block in an uptrend is the last down candle before price break structure, right, that's basically a demand zone, right? Now, in a downtrending market, right, the last up candle before price break structure, right, is considered an order block, but you also can call it a what? A supply zone. Okay. Now, we went over that, right? We went over an uptrend. Now, let's go find a downtrend. All right. Let's go find a downtrend and we can see how to properly, right, attack a downtrending market. Okay. So give me a second. I'm going to just go back in time, right? Just to show you guys that this method is extremely powerful. All right. Now, can anybody tell me, based off of what we see here, right, what type of market this is? Of course, I just told you, but based off of what you're looking at, right, what type of market is this happen? What type of market is this happening to be? Right. If you said downtrend, you are right. All right. Downtrending market. So what should we be doing, guys? If we're in a downtrending market, what should we be doing? Right? What should we be doing? Selling, selling. And we're only finding areas to sell from. Again, I'm going to repeat this. This method works on every single time frame for every single pair, right? You just have to follow the trend. Now, understand the higher time frames rule all. All right. Any lower time frame is overpowered by the higher time frames. So for me and the type of trader that I am, right, at heart, I am a swing trader, meaning that I love to spend my time on the higher time frames so I can see the true trends of what's really happening. Now, you can trade on the smaller time frames, right? But you just simply have to um, understand, right, what the higher time frames are truly doing. Okay. Now, how do we know that we're moving in a downtrend? Price creates a high, price creates a level here, it pulls back for price to actually break this previous level here, right? And if it breaks this previous level to the downside, what do you end up getting? You end up getting your break of structure, right? Once you get this break of structure, it's going to create a new low for then price to do what? Retest, right? What are the three levels that price can actually go to? Name them out. I need everybody that's on this call right now, everybody that's on this call to call out the three areas, the three key areas of values. All right, everybody, right? Before I go and I see what everybody typed, I need to see all of the responses from every single person that's on this call, right? Every single person. All right, let's go. We need about seven more responses. Let's go. 6 more responses. Let's go, guys. Everybody has to participate. I want everybody to participate. All right, good. For the most part, everybody did participate. Now, you got the breakup structure. Can anybody tell me where price actually retested to over here? And did it come back to one level or did it come back to two of the levels that I've already given you guys? Right? If it's one thing I can guarantee in the market, when price breaks structure, it's always going to come back to one of those three levels every single time. That's one thing that I can guarantee 100%. All right. That is one thing I can guarantee in the market 100%. Can anybody tell me, right? Did it come back to one level or did it come back to two levels that also are coinciding with each other? Right? It came back to a structure level and an order block. Here's the thing. If price happens to create two levels within each other and price comes back to that, that's like double confirmation that price is showing that that is a strong level. All right. So good job, Chase. Right? It came back to a structural level as well as a order block. All right. This is your structural level from wicks to bodies, gives you your structural level. All right. All right. So you have your structural level here. All right. And then there's also an order block right above that level right here. This is one of the last up candles before price moved to the downside. All right. Boom, boom. And we see how price came right back to that level, right? And gave us our order block, right? Reacted and respected both of these levels. Now, for example, right? We want to see bearish candles closing below our areas of value, right? Boom, there you have it. Boom, there you have it. A 500, at least a 50 pip SL for at least a 50 pip gain. What happens? You aim for your 1-to-1 risk to reward ratio. You got it. Money's made. Now, again, if you want to go for 1 to 2, right? What's 50 plus 50? 100, right? 100. So you have your 1 to 2 risk to reward ratio. And if you see that, price goes and actually attacks your 1 to 2 risk to reward ratio. All right. That means you have double of the chances to actually make more money than you would actually lose. All right. So if price happened to even break above this level and it broke above and closed above these levels, then you know price was actually meant to happen and it was meant to go that direction. All right. If it breaks an area of value, it was meant to actually break that area of value. All right. And those are just trades that you would actually have to go, right? You would actually have to just take that to the chin and take that loss, right? Those are some of the trades that will actually, you know, be like that, right? So what happens? You get your breakup structure, right? You get your BOS, all right? Price creates these new lows in the market. It creates these new lows, right? For price to retest back to where? Can anybody name out those other two levels, right? There's two levels that price came back to once again, right? What two levels did it come back to? Come on. I don't want Chase to be the only one to answer this now, right? Everybody should be able to answer where price actually came back to, right? An OB, which is an order block, what, let's see. An order block, and then there's another level that price came back to, right? There's two levels in one. There's two levels in one, right? What's the next one, right? Remember, when price breaks structure, we want to find the last up candles before price actually broke that level of structure because then that's our order block. But then there's also from wicks to bodies, right? That gives us our structural level. So from here to here, you get your structural level, right? We drag that across, right? But right above that level is also a order block, right? You have your structural level here, and then your order block level right above that. So again, if I'm getting candlesticks closing above, let's say you missed this move right here, right? And price came back to respect these levels once again, right? Let's say it came back to those levels once more again, and you did not see this move happen. Let's say we came back to this level once more. SLs go back above this level for at least 50 pips, right? And then you're aiming for what? Again, at least a 1-to-1 risk to reward ratio. If you notice, you end up going into profit, price pulls back into the negatives, and then it eventually goes and hits your take profit. Now, here's something that I do want to show you guys, and I do want to tell you every trade that you get in is not immediately going to go into profit. I'm going to say that again. Every trade that you get in is not immediately going to go into profit. There are going to be times where you have to deal with drawdown. That's the whole purpose of you placing your SLs above these areas of value. That's the whole sole purpose of that. All right. Because it gives your trade room to breathe so that way you can attack the market properly. All right. And have the patience and the know, right, and the will to actually hold these trades, right? Because like I said, every trade is not immediately going to go into profit. Okay. You see here, you made your money, you go about your day. What ends up happening here? You get your what? Your breakup structure, right? BOS, for then what to happen? Price to create these new lows, for then what? Price to retest back to where? An area of value. In this case, right? Price came right back to this particular area of value. This is also one of the other up candles before price broke structure, right? From this candle's wick to that candle's wick, right? The entire buying candle gives you a what? A order block level. Okay. And all we need to see from that particular level, right, is a candlestick. Doesn't matter if it's big or small. You just need to see a candlestick close beneath your area of value. Okay. So let's just say you were an aggressive trader and you wanted to use this particular candlestick. You could have, right? SLs will have to go above. And this is a perfect example to show you that what if you even was aggressive to actually take this entry right here, right? Price, what ends up happening? It ends up going against you, right? You're in negative, you're panicking, what you should not be doing, right? And then what ends up happening to price? It ended up shooting down and actually taking out your 1-to-2 risk to reward ratio, right? You want to at least aim towards the lows for the most part, all right? Or aim towards the highs if you're moving in an uptrend. Okay? You guys see how that operated, right? You gave your trade opportunity to breathe, right? So that way it can actually hit your take profit. That is what you call patience, right? Patience. Mind you, this is on the 4 hour time frame. So this took a total of 4, and then boom, right? So 4 plus 4 is 8, right? Was 8 plus 8, 16, right? For price to do what? Fall down 100 pips. Everybody see that, right? Again, what ends up happening is price break structure, right? For price to fall down to create these new lows in the market, right? New lows in the market. So that way price can do what? Retest. It creates these new lows and it comes and finds a what? An order block. And as you see here, guys, what type of pattern do you get at this order block? Right? What type of pattern do we get at this order block? Can anybody tell me what this one is called right here? Right? Anybody that's still on the call, right? Can anybody tell me the pattern that price created here? Right? It can be considered a Mike, you're right. It can be considered a triple top, right? But it also can definitely be considered a double top, depending on just how you're looking at it, right? But for these purposes, we're going to say that this is a double top. Yes, we have price pulling back to certain levels, but remember, price pulled down to pull back up here, pulled down to pull back up here. So naturally, this is a double top, right? You can see this as a triple top, but naturally, this is a double top, right? What ends up happening to the market, right? What ends up happening to the market is price creates this double top. Let's say you missed this move to the downside and then you caught price pulling back up, right? Let's say you got the break of structure here. Sorry, right? You got your break of structure here for price to create these new lows. So that way it can pull back up for price to actually move to the downside. Okay. So let's say we caught our entry here. SLs will actually go above this particular order block, right? 50 pip SL for what? At least a 50 pip gain, right? That's at least, right? That gives you a 1-to-1. Now, if you want to go for a 1-to-2, of course, what is that? 100 pips. But if you want to go for a what? A 1-to-3, right? What's 50 plus 50? Or 500 plus 5? What's 500 times 3, right? 1500. Or 50 times 3 is 150, right? That gives you a 1-to-3 risk to reward ratio. You make your money, you go about your day. All right. All right. So that is all for the examples that I have for you today, right? You guys seen it in real time based off of the examples that I've given you guys at the very beginning of the call, right? Up until just this last moment, right? Right? From this particular moment, right? From here all the way to those particular moments that we just previously went over, right? We basically went over everything, right? The only thing that we did not see in the market, right? That we possibly could see eventually is the market shapes, right? And that's okay, right? Sometimes they come, sometimes they don't, but you will often see these bullish market patterns in these bearish market patterns, these areas of values and these trends, right? Uptrend, downtrend, sideways moving market, right? All right. Now, I got a message inside of the chat, right? And I feel like this will be good for anybody that's watching the recording based off of what the question that was asked. They basically asked, let's see, and we can read it together, right, guys? Gary, what would you go over your daily and weekend routine for looking for trades? And how long are you on the charts? And are there specific times you're looking? All right. So to be honest with you guys, because I've been doing this for a while now, it does not take me long to decipher what I feel like I could be aiming for or going for in the market for that week, right? It usually can take me as little as 5 minutes or possibly even 30 minutes to determine what I can feel like is going to happen for a pair. Um, based on what I'm looking for that particular week, right? Because at minimum, I'm taking at minimum at least 2 to 3 trades every week, right? I don't like overdoing it. Based on the time frame that I'm looking at, it doesn't allow me to overdo it. It maximizes and minimizes the number of trades that I'm taking, right? So it could take literally, I can spend my entire weekend doing what I want. Come Sunday, I may spend maybe, like I said, 5 minutes, 30 minutes, maybe up to an hour to determining what pairs that I'm looking at for the week, to know which direction I'm looking to take it in. All right. That for that question. All right. Now let's go back and read it again. That's basically me going over the method with you guys is my weekly routine. I literally look for, if it's a downtrend, then I'm looking for sales. If it's an uptrend, I'm looking for buys. But I'm looking for, and I'm patient to look for price to come back to these 3 areas of value. Right. That's what I'm looking for. Now, there's a couple more questions. And how long are you on the charts? Oh, I basically answered it, right? Um, like I said, I stick to the time frames. The most is probably the 4 hour time frame. All right. I don't I tend not to go below that unless it's the hour time frame. So between the 1 hour and 4 hour time frame is where I spend most of my time, mainly the 4 hour, because that gives me the true trend of what's really finna happen. And for that particular pair that I'm looking at, for the time being, right? And for me, I don't trade a multitude of pairs. I trade at least four pairs throughout the week. If one trade is giving me something and the other three is not, then I'm trading that pair. If two trades are giving me something for that week and a couple of others aren't, then that's what it is, right? But I don't overdo it, right? I at least have I at least have 4 to 5 trades that I'm looking at throughout the week, so that way I'm able to capitalize, and I don't um look at a crap ton of pairs at one time. I look between 3 or 4, maybe 5 trades out of the week for me to attack it in a certain direction. All right. And hopefully that answered your question. And yep, I can answer this question. So everybody was able to get that question, see how I attack the market, because the same way that I'm explaining it to you guys is the same way that I come onto the market to determine what I feel like is going to happen next, right? Based on the method that I do use. All right. And if you guys want to take a picture of this, please feel free. All right, please feel free to take a picture of this so that way you have it and you're able to even go back and actually watch this recording over again. All right. So with that being said, guys, I appreciate you guys for watching this recording. Um, do me a big solid, subscribe, share, right? Bring people on to actually learn this skill set, because everybody has the ability to learn it. I will gladly appreciate it. Again, my YouTube channel is The Silent Pip Assassin. The Silent Pip Assassin, right? At The Silent Pip Assassin, no spaces. All right, and you can go subscribe to my YouTube channel. Guys, this recording will be up very soon. All right. So with that being said, guys, I appreciate you guys for getting on. I appreciate those that are going to watch this session. With that being said, guys, if you have any other questions or concerns for me, you can contact me at my Instagram, which is Gary Scott Official. Or you can hit me inside of the community, guys, so that way I can answer any questions that you do have. All right. With that being said, guys, it's your boy, Gary Scott, aka the Solid Pip Assassin, and I'm out. Peace.